we need to be that means that the primary risk that we need to be concerned about is where is implied volatility today and where has it been historically? Because after all, every stock has a range of implied volatility. And of course, it's not the stock, it's its options. So when you see the broker's website and it says, it gives you an answer like Apple's implied volatility is 35% or something like that. What it really means is that some kind of average of the options, of the implied volatility of the options that are near at the money, just out of the money, just in the money, is some average of those to get that number for Apple. And in fact, that's why you will see different brokers giving you different numbers, because they may have different ways that they average those numbers. But the bottom line is every stock has a range. Apple may be like 25%, maybe the lowest it ever gets, and maybe it gets up to 80 or 90% when it gets close to an earnings announcement. Something like Procter & Gamble, probably it's more like 10 or 12% up to maybe 20%, much more narrow range. And then something like Tesla, of course, is crazy. It probably never gets below about 40, 45% and can go as high as 150, 200%. The point is, whenever you look at your stock and you're thinking about executing a calendar spread on that stock, first you have to know where is the level of implied volatility today, and where has it been in the past? Are we close to the bottom of that range? So therefore, I can reasonably expect that it's just going to stay there or go higher, which will be in favor for this trade. Or is it more with mid-range or even high, where it's more likely to go down? And of course, that'll be a disaster for this trade. So that's the most important thing you have to check before you ever enter your calendar spread. Now, you can find implied volatility data on your broker's website. A good free service is ivolatility.com. Larry McMillan's website, optionstrategist.com, has several different services, but the one that is particularly relevant for this is what he calls the strategy zone. And they basically download all of the IV data for all of the publicly traded stocks that have options every night. And you can see the current IV as well as the percentile of that IV over the past year of implied volatility data for that stock. And he has a lot of different screens in that service as well. So I'll give him a free plug there. What about directional trades? Well, it's all about where you position your call calendar or your put calendar. In other words, if you're bullish, what you ought to do is position your call calendar up above the current stock price. Because as the stock price rises and gets closer to that strike price of your calendar, that calendar will gain in value. And in fact, what you'll notice if you price these is the farther out of the money you go, the cheaper that calendar gets. And some people, as a consequence, use these as hedges for their trades, kind of the what if I'm wrong trade, if you will. Because you can position an out of the money call calendar up above or an out of the money put calendar down below. And if the stock price goes opposite what you were experiencing or predicting, then you can hedge some of that loss. Well, on the other hand, what if you're just delta neutral? You think the stock is just going to wander sideways. Well, then you position your counter spread at the money and you use calls or puts based on what you think might happen if you're wrong. In other words, it's kind of like you're looking at this and saying, I'm pretty sure it's just going to wander sideways, but if I'm wrong, I think it might go higher. And so you would use calls, even though you're positioning it at the money. And then, of course, in all of these, even though it's a directional trade, you have to be aware of the vega risk. So therefore, not only get into it at the right volatility, but as you get into it, every time I put one of these on in my trading journal, I write down the implied volatility of each leg of the spread. And I track that every day because I need to know where is volatility trending. In fact, I would recommend that you not only have stops for the price of the stock, but also for the volatility. So volatility sensitivity. We've already said that this calendar spread is very sensitive to implied volatility. Well, why is that? Well, I mentioned the option Greek called vega. And it's interesting that that's the only one of the Greeks that doesn't have a Greek letter or a Greek name. They just made it up. It starts with a V and it's volatility, so they called it Vega. If you read academic literature about options trading from a typical business school or something like that, they will use kappa for the option Greek that monitors the Vega, or the, sorry, still fixed on Vega, that monitors the change in the option price every time the volatility goes up. And Vega is largest at the money, and it gets larger as we go out in time. So therefore, if you put on that calendar spread at the money, the Vega for the one you sold is smaller, quite a bit smaller than the one that's farther out several weeks or a couple months. What that means in practice is if volatility goes up in those options, all those options, both the options you have, it's gone up in the front months, which means you've lost money because that option that you sold is now more expensive. But that same increase in the farther out option that you own actually made you more money than what you lost in the front months. And that's the power of the increasing volatility. And as a matter of fact, it doesn't have to be the same. If volatility went up by 1 percentage point in the short option, and it only went up by 0.5 percentage point in the long option, what you will find is that typically you're still making money, you're still profitable, because the larger Vega gives that long option more punch for that 0.5 point increase, because it's a larger value of Vega. So that brings us to the question, why couldn't we just use calendar spreads to play volatility? So if you think volatility is going up, this is a very good way to profit from that. And typically, the most common prediction we might have is for increasing volatility as we have an earnings announcement coming closer. So what you typically do is you buy the long option in the expiration that's just after the announcement. And why do you do that? You do that because that's the option that people that are speculating about this earnings announcement, because there's people out there bidding them up. You'll see all the prices of these options going higher. That's the implied volatility after all. Like, higher implied volatility comes from the bidding process in the auction for the options. So as that goes up, you want to own the option that is being used for that bidding, so to speak, being used to bet on their prediction. And typically that's the option right after the announcement. Why buy more time? You're just wanting that one option. So that's one you buy, and then you simply go at the same strike price in the current week or current month, and that's one you sell. And so what you're selling is the value to offset that long option that's more expensive. But what you're doing here when you're trying to play the volatility rise is you're setting this up, and then over time, you're probably rolling out that front option so that you're continuing to work down the cost basis of your long option. Or it could be that you just do this over a couple of weeks around the earnings announcement. But in any case, what you're banking on is that volatility is going to rise. Your long option is going to gain in value more than what it costs you in the front option. And you will close this before the announcement. That's a key point. Be sure that you close this before the announcement. Because once the announcement occurs, implied volatility collapses on all these options. Let me give you a couple of examples that we've done recently in our trading group. This one was with Tesla, which is, it's a good trade for this kind of, or it's a good stock for this kind of trade, because the implied volatility is just wild. It tends to be very high. Now, on the flip side, why is implied volatility high? It's telling you that the market's banking on big moves up or down. It's not telling you if it's going up or down, but it's telling you the probability is that it's going to have some big moves. Well, that's risk. So clearly, we might like the idea that it has a lot of volatility and those are rich options, but they're rich for a reason. In any case, we put this on in, let's see, when do we do this? On the 15th of October, because the earnings announcement was scheduled for the 20th. And we came up to the 18th, right before the announcement, closed it out. $72 per spread, 16% in a couple of days. Now, in this case, We were forced out of it earlier. We would have liked to have gone right up to the 1020 and closed it that day, because you typically get a lot of increase in volatility even in that last day. But we couldn't, because the stock price had gone from 840 when we started to 870. So in other words, it was pressing up on the upper end of our break-even range for our spread. And so we closed it out for a 16% gain. You don't want to let that go too far, because the stock can go high enough or low enough that your spread will start to lose money. But then an interesting thing we did, we immediately turned around after we closed this one and opened this one at 860. Paid $517 for that, closed it on the day of the announcement for 24%. So in a couple of days, made 16%, a couple more days, we made 24%. But the point I wanted to illustrate with this was just simply the fact that you can have one of these trades, say 2 weeks ahead of the announcement, a week ahead, whatever. And if the stock price moves up too much, you can simply close it. And if you close it promptly, you will close it for a profit. And then you can readjust by putting on a new calendar spread that's closer to the current price of the stock. So what we're illustrating here are several points. One is the price risk, that you may be forced out of the trade early. But if you monitor this, you should be able to get out with a gain. These two calendars also illustrate the power of that increasing volatility. We were making good profits in just a couple of days because of the implied volatility rising. Now, the other example I was going to review with you briefly is Palo Alto Networks, PANW is the ticker. Now, this one, we had an earnings announcement scheduled for the 15th of November. And on the 15th of October, I was looking at this trade. Palo Alto was trading basically sideways. It seemed to be kind of wandering, didn't really have a trend or a direction. And so it looked like a perfect setup. Because this is unusual. I normally do not play these kind of trades on volatility a full month ahead. And the reason for that is simply that usually the stock price moves a lot during that last month before the announcement. Very often you'll see stocks starting to trend one way or the other before the announcement. And of course, that is going to force you out of the trade. So the fact that it was already kind of wandering sideways a month early, I thought, well, this might work just fine. So what I did is I bought the November 19th 510. It was trading around 510. So I bought the November 19th because that's the one nearest 11:15. In other words, an announcement will happen on the 15th. A few days later, that option is going to expire. So that option is the one that everybody that's bidding on this stock and saying it's going to go higher, I'm sure, it's going to go lower, I'm sure, et cetera, they're buying those options for November 19th. Then I sold the current one, the 1022. And so on the 22nd, I rolled that out, brought in a credit of 485. Because remember, we paid quite a bit for this calendar. That brought it down quite a bit. On the 27th, I did it again, rolled for 220. And then on the 3rd of November, I rolled for 355 out to 1112. Now, it turned out it kept running higher and lower. And so on the 9th of November, I decided there was a nice profit here and I wasn't going to kind of take the risk. It was down to 498. I still have a calendar at 510. So it was starting to, kind of weaken. And I was a little concerned about that. So I closed it early. Now, through those 3 rolls, we had reduced this 1305 cost down to 245. That's the power of doing it early, but the danger, like I mentioned, is the price might force you out early. But because of that, we've got a return on investment that is rather enormous, actually. Not very often that I get 3-digit returns, maybe a few times a year, but not regularly, because normally to get 3-digit returns, you're taking a lot of risk, and that's not my cup of tea. So in this case, what we were seeing was the power of that volatility. The short calls went up from 23.4 to 24.9%. So it went up 1.5 points. The long calls moved up 2.1 points. Now that's somewhat unusual. Normally you expect your long calls to just kind of keep up in terms of the point rise. And you depend on the larger vega to give you the profit of that longer call. But in this case, they traded up faster and there was more demand for those options. And so it really ran. Now, the Vega of the 510 call farther out, November 19th, was 47. The Vega, this most recent one we sold, was 25. So you can see the difference there. Remember, what this says is it tells you that if the implied volatility of this 510 call goes up by 1 point, the price of the call will go up by 47 cents. Same thing here, only it's 25 cents. So you see the difference here is why the stronger Vega, the larger Vega, helps you so much more than what you're losing on the front month option. So I've been pretty brief here. Obviously, this is you could actually have 2 or 3 full-hour classes on calendars. One of the things I didn't talk about at all is sometimes when you're just trading your calendar spread as a sideways income generating type of trade where you're not expecting any announcements or anything like that. Well, typically in that case, you might prefer a double calendar. Sometimes when a stock price is in between strike prices, you'll actually set up a better trade by moving up slightly and setting up your call spread just above the stock price and setting up a put spread just down below the stock price, a double calendar. And that will cover, you'll have a break-even range that's even wider, but you will have to invest more money because you'll have more money in those 2 calendars than you would in one at the money calendar. So that's one thing we didn't talk about. Otherwise, I think we've touched on most of the points that you need to be concerned about. I emphasize once again, always monitor implied volatility. Know where it is when you get into this trade. Follow it while you're in the trade. Follow it every day. Don't take that for granted. It's very important. Now with that, I think we have time for some questions, if there are any.
Yeah, no, I think that was a great presentation, Dr. Duke. We did have a couple of questions that came in while you were presenting, and the first one is, what are the advantages of a calendar versus a diagonal? So,
well,
that's very different strategy, but very similar strategy, I guess, at the same point, right?
Yeah, you're right. The main differences are these, I think. The diagonal spread typically is used for a directional trade. And I actually like, when I'm bullish on a stock, I like diagonal call spreads because, and part of the reason is similar to what I did with this Tesla calendar. Each week I can roll that call out, the short call, and work my cost basis down, which of course increases my ultimate profitability. And by the way, another advantage of that, just like with Tesla trade, we started out with a $1,300 debit. Well, that's your maximum loss. If everything goes to hell in a handbasket, that's your loss. Well, same thing with diagonal. And as you're going forward and rolling those short calls out, well, that cost basis is going down, so your maximum loss is going down. So that's what I like about the diagonals. But it is similar to a calendar in that sense, but it's usually more directional. Although if you're going to play the calendar spread out of the money as a directional trade, that's a pretty good idea. It'll work pretty well. And very often you'll probably put a little less money into it, but you have to have that stock price move. You can't just have it wander sideways. And in the case of a calendar spread, if you're playing the calendar spread at the money, you've got a pretty wide range of the stock price movement that still enables you to be profitable. So I think if you're delta neutral, I would favor the calendar spread at the money. If you're a little bit bullish or neutral, kind of like mildly bullish, well, diagonal call spread is a pretty good way to play that, because if it just wanders sideways, you'll make money on that just like you would with a calendar. And as you roll out, you'll actually decrease your cost basis. So they have they share some characteristics, but they are a little bit different.
Absolutely, that makes a lot of sense. And then we also had a couple other questions. First off would be, will the calendar make money if the volatility stays the same?
Yes, it should, because what you're doing, the basis of the calendar spread, ignoring volatility, is that difference in time decay. And so you should benefit from that. One of the things I didn't mention that is very favorable about the calendar spread is typically, if you don't have implied volatility declining, typically it's very unusual to take much of a loss. You have small losses with these. Even on the ones that I've played against earnings announcements, sometimes the volatility shifts. In other words, it maybe went up a little bit in the front month, but it didn't go up much at all or even declined in the back month. In that case, volatility is actually moving against you. It's a skew that's setting up between the two legs of the trade. And so sometimes when you have that happen, you're taking a loss regardless, and the time decay isn't enough to make up for that. But if volatility stays flat, then you're good. You can make money just based on the time decay.
Muted. There we go. Excellent. Thank you very much for that response. And then there was one more that we got here, and it's how do you determine your profit, I guess, projected profit on a calendar?
That's hard to do.
Yeah.
I mean, effectively, I forgot to show you my email address if you want to send me a note, but effectively, you have to have some software to set up your risk reward curves for a calendar spread. And the reason for this is that you've got several moving parts. When you have implied volatility, you have to project where you think implied volatility is going to be at particular points in time. And then, of course, also, where is the stock price going to be? So typically, you have to have some software. Sometimes your broker will have something where you can plot that risk reward curve, and that'll give you a feeling for that, feeling for where your break-evens are, and also a feeling for your maximum profitability. Although, as I pointed out in the presentation, if implied volatility moves in your favor, one of the huge benefits of this trade is your profitability that you thought you were going to make actually starts getting larger, and your break-even range starts getting larger. So it's harder to lose money. So implied volatility is huge in this trade on both sides. It's huge in the sense if it moves against you, it's going to kill you. But if it moves in your favor, it's like a wonder drug. It's just wonder to watch. But trying to plot that in advance, you can't really do it. Even with the software, you have to remember it's giving you a plot, but it's doing it based on whatever kind of projection algorithm is built into the software for the implied volatility changes. And so you're at that mercy, if you will.
Well, it sounds excellent to me. So for those of you that have enjoyed this presentation, please come back to optionhotline.com. We've got lots of presentations coming your way. If you have any questions, feel free to email us at support@optionhotline.com. And I hope that everybody has had a great experience here with Dr. Duke. Thank you again, and we'll have you on soon.
You're welcome. I was glad to do it. Thank you.
Thanks to all.